Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your rates rundown for December 12th, 2025. This has been a fairly volatile and, dare I say, defining week for rates, anchored by the Fed's rate decision and release of updated economic projections on Wednesday. Week over week, 10 year Treasury yields are higher by a little over 12 basis points out to 4.19%. Meanwhile, the average 30-year mortgage rate is higher by about 2 to 3 basis points after briefly coming within spitting distance of their best levels of 2025. So let's start with the Fed's rate decision. As expected, the Fed cut 25 basis points, and their rationale for doing that was a familiar refrain at this point. The Fed continues to see downside risks to employment, and that risk is perhaps rising, while inflation, on the other hand, is still seen as being tariff driven. For those keeping score at home, that makes 75 basis points in cuts since September and 175 basis points in total since September of 2024. Consistent with several of the recent rate decisions, this one was not unanimous. One member wanted to go 50 basis points, while a couple of others would rather have seen no change this time around. Looking at the summary of economic projections, often referred to as the dot plots, which shows how members of the Fed foresee some key economic data might unfold over the coming years. Um, they're showing inflation will continue to run above target for multiple years, not hitting their 2% goal until 2028. GDP was revised up slightly, most dramatically in 2026, but that's partially reflective of the shifting of economic activity from late 2025 into early 2026 due to the government shutdown. Interestingly, this increased growth is expected to come with no improvement to the unemployment rate. They're calling it increased productivity, but that's really kind of a nice way of saying AI is getting ready to take your job. Uh, I'm partially joking there, but this is important to note because recall that the Fed has only two mandates, right? One is price stability, that's inflation, and the other one is maximum employment or jobs. The Fed is currently positioned to defend jobs. And if they can't count on growth to help with the jobs picture as it has in the past, then it stands to reason that defensive positioning could become much stickier. And that's a potential can of worms right there. But we're going to burn that bridge when we come to it. So we're not going to get too far into that. Finally, the median expectation among Fed members is that there will be one more cut in 2026. The Fed now sees their policy rate as being broadly neutral, which is where they have wanted to be for some time now. They don't want to be restrictive. They don't want to be stimulative. They want to be free to act in whatever direction the data dictates. Overall, this was a marginally more dovish announcement than what was expected, and that can be evidenced by the fact that the front end rates, right, 2 years and in, call it, moved lower, even though the 25 basis points had already been priced in. Meanwhile, persistent inflation concerns pushed the long end, including mortgage rates, slightly higher. Let's talk about next week real quick because that could be a fairly volatile one. We're finally going to get some updated jobs data, November payrolls and unemployment rate, which, as you'll recall, will include October data as well. Will be released on Tuesday. We'll also get some important inflation data in the form of retail sales, CPI, that's consumer prices, and core PCE, which is personal consumption expenditures, which is the Fed's favored measure of measuring inflation. So all that's very important and potentially market moving. So my key takeaways for this week is a return to an on-hold Fed is very close and perhaps is already here. The Fed sees current policy as being within the range of what should be considered neutral. So that's one less thing that should be influencing policy going forward. Mortgage rates are slightly higher on the week, but still trading near their 1 year lows. Remember, mortgage rates aren't controlled by the Fed. They are most correlated with 10 year Treasury rates, which are a product of market expectations around the broad health of the overall economy. And the tug of war that exists between Fed easing and recession concerns on one side and inflation persistence and risk premium on the other side should keep long-term rates pegged kind of right around here. The Fed is confident that inflation is largely tariff related, so they'll continue to act to support labor markets unless inflation spikes beyond what can be reasonably attributed to tariffs, then that might change. And finally, crumple all this up and throw it away if the unemployment rate hits something north of 4.7%. That would put labor markets in a spot that's outside even the most bearish of Fed members' expectation, and policy will therefore have to shift from preserving a soft landing to defending against recession. This would be a negative for the overall economy, but it will push long term rates lower, and mortgage rates should benefit as a result. That's all I got for this week, folks. Hope you have a great weekend, and we will see you next time.